Kaizen was designed to be a safety net in this market where everybody's uncertain about where interest rates are going. Are we going to have recessions or depressions? What's going to happen over the next 15, 20, 30 years? Kaizen was designed by us for ourselves to address that fundamental concern. So welcome everybody to NIW Live. I'm by my lonesome this morning, so I will be able to say what I want to say without being criticized or interrupted by my partners. There are a lot of questions coming up about the rising interest rate environment and how does that impact us. So what we thought we'd do is kind of break it down into a series of modules to help you understand the economics that goes on behind Kaizen and Trizen, so that you can kind of articulate it in language that you're more familiar with as opposed to insurance gobbledygook. As always, we ask you to hit the subscribe if this is a subject of interest to you so that we can continue to provide you useful and educational information. The objective here is to educate more than anything else so that you can just, whether you buy a Kaizen product or a life insurance product, this information will just help you overall understand what's going on behind the scenes, if that makes sense. My name is Daen Wombwell, part of the NIW team. I've been doing this for 22 years. Let's see if I can impart some of what has been hammered into my thick skull to help other people. So if we remember what we're trying to do, behind the scenes on retirement, the issue that's preventing most people from hitting their goals is I need to figure out how to get more money in my plan. Let's remind everybody that 74% of what's going to decide how much money you actually have available is how much you invest. Only 26% comes from investment return. So if that's true, what we need to do to really address the core issue of maintaining quality of life is we need to figure out how to get more money in play. Well, to expect you to give up your quality of life to get there is not realistic. And people are just not going to do it. Just like the mortgage market was for banks, we need to figure out how to get leverage money or bank money into the game. Now, to do that, we have to have an asset type that they're attracted to. And when you're looking at it from a bank's perspective, the reason they like houses and the reason the 30-year mortgage exists is they have an underlying asset that's securing their loan. They can have a very high probability of getting their money repaid, so they're safe. They can value it, and the administration of it is relatively straightforward once it's systemized. Here's the problem. Traditional retirement tools aren't that. They're stocks and stuff like that goes up and down in value like a yo-yo. You have all sorts of securities regulations around it. It's just not an asset that banks would naturally lend large amounts of extra capital to it. All right, so the start point is to fix the problem, we need more money. To get more money, we need to be attractive to the banks. So how are we going to do it? So if I can get my clicker to work, if we look at what Kaizen was designed to be, and Trizen is just a variant of it for certain applications, so we'll use ubiquitously Kaizen. Kaizen was designed to be a safety net in this market where everybody's uncertain about where interest rates are going. Are we going to have recessions or depressions? What's going to happen over the next 15, 20, 30 years? Kaizen was designed by us for ourselves to address that fundamental concern. So we're comfortable that we've designed it with that in mind, and now what we're going to go through is the economics and the proofs behind that. The other thing to bear in mind, the illustrations that so many people in the insurance industry rely on really don't reflect product changes over time. What they tend to do is take a snapshot of today and say the conditions of today will exist forever. Well, that's never happened except for one day, right? So what we know is that statistically with the Index Universal Life, the product we're using here, caps will go up and down with interest rates in a lagged fashion over time. Now, we built stress testing into this stuff, and the purpose of that is to say, okay, we don't know what the future holds. So let's build some buffering that can account for the kind of storms that have happened in the past at very high degrees of severity. So, to take an analogy, if hurricanes hit the Miami city pretty frequently, let's design everything to withstand a Category 5. That kind of thinking has gone in. So let's drill into that and provide some additional information on what's going on. So part one of this program is going to talk about the construction and the underlying economics behind the IUL. When you understand that, we can start to introduce its relationship with interest rates and how they affect each other. So first of all, I'm going to introduce you to some language the financial industry uses ubiquitously, but is not everyday language you and I would use when we're talking over a beer to our mate. So let's start with the language of a bond. People talk about bonds all the time, but what is it? It's just a fancy word for debt. So Apple or GE or a municipality issue an amount of debt. My bond to you, if that's the play on words, is that I'll pay you a certain rate for that debt, and I will repay that after a length of time, let's say 10 years. And what's important is to get the definitions right, because people get confused about that. So that all we're going to do is try and put some lay language around that. So when you hear bond, just think debt offered by somebody with a promise to repay. Now, the par value is the face amount of debt. So how much debt are we issuing? So I might be doing $1 million of debt, but I'll slice it up so lots of people can buy it into $100 pieces. And that's the amount I'm going to repay you at the maturity or the end of the loan period. So we'll talk about par value, and then we'll talk about something called coupon rate. Now, coupon rate is nothing more than I will pay you a certain rate per $100 that you lend to me. So let's say that today I will give you $4 for every $100, or at today's rate, that would be 4%. Now, these are important points because they'll change the terms over time, but they'll always pay $4 per $100 of debt that you've issued. Now, yield is because bonds are bought and sold all the time. If interest rates suddenly go up or down, in order for me to be at parity with the prevailing interest rate, so let's say I've got a 4% bond and interest rates go to 8%, nobody wants to buy my bond. So my yield has to change to reflect. So although it's paying $4 per 100 every year, I've got to somehow move that to become an 8% return on my investment. So the last thing we want to talk about is something called mark to market, which is the change in the value of the bond that I can sell it at, the price I can sell it at, so that my effective rate that's being paid is in par with the market or in line with market, so I can sell it. And just a simple example of that might be if today's risk-free rate, the treasury rate, is like 2%, let's say I'm Apple, I'm obviously going to have to offer a higher rate than treasuries for people to buy my bonds. So let's just say that's 4%. So I'm giving a 2% risk premium or extra return for the risk over and above what the treasury rate would be. Now, if I'm issuing a $100 bond and I'm offering a 4% rate, I'm going to pay $4, right? So the interest rate suddenly goes up. As the Fed raises rates, let's say the risk-free rate goes up to 4%, and now I have to offer 6% to anybody who wants to buy that bond, because another person will be selling another bond, but they'll be giving 6%. So how do I do that? Well, the bond is still paying 4%, so what happens is the bond price, or its mark-to-market value, goes down. In this case, $66. So if I sold you the bond for $66, but it's still paying out $4 a year, that's equivalent to a 6% rate of return. So that's how bond prices, their mark-to-market value, go up and down with interest rates quite markedly. And that turns out to be super important when you're talking about leverage, because if you're in a rising interest rate environment and the security of your loan can you lose value, that scares the bejeebers out of banks. So just to restate the point I made earlier on about risk premium, as far as we're defining risk premium, that is the extra money that the market or somebody has to pay for the risk above the alternative. So, for example, If I'm offering a stock versus a CD, obviously you expect the return on the stock to be higher because it's more risky than the CD, right? Or real estate versus something else. So risk premium is just defined as the extra return you get for taking the risk over whatever you're comparing it against. And we'll use these terms as we go through and explain how this product works. As we're looking at risk premium, what we're really going to talk about is the risk premium versus the bond or versus the bank loan. So that's where we're going to zero in on risk premium. Okay, so now let's talk about if I have bonds, obviously my yield, the rate I have to pay today, is going to be driven by interest rates. And you cannot divorce the two from that in the conventional sense. So as soon as the Fed changes interest rates, my bond returns are going to change immediately, right? And everything's pegged against the risk-free rate, which is deemed to be treasuries or equivalent thereof. So as I show on these charts, as we'll show some visuals to support this, all we're sort of showing is, look, if I have more risky bonds, they're going to have a higher premium, risk premium versus treasuries versus good credit bonds, right? So AAA bonds, you hear this phrase all the time, is highly rated bonds that are very, very, very good credit, very small premium over treasuries. But the junk bond market you may hear about, they're very risky, so you can have a much, much higher return on those, but you've got much higher risk associated with it too. So the next thing I want to introduce you to is something that's really, really misunderstood by so many people outside of the insurance industry. And that's the difference between a bond portfolio and the general account of the carrier. Now, you will hear, and it is correct to say, that when you make your premium payment for life insurance, except for variable policies, that money goes into what our industry calls the general account that is largely made up of bonds. So why am I talking about the difference between the two? With a bond portfolio, the yield that you are paid is basically controlled by the daily interest rate environment. It goes up and down daily. Now, it might not go by much because it's a pretty stable market, but it does change. So the market value of your bond portfolio fluctuates daily. You don't have any overall principal protection unless you hold that bond until the day it matures. So I promised in 10 years' time I'd pay you back the $100. I'll pay you that in 10 years' time. But if I need to sell that bond in year 5, that value may have gone down because interest rates may have gone up, for example. So bonds can be particularly adversely affected when interest rates are rising. And that's when, if you think about bonds, they're supposed to be your safety net. Well, it's great when interest rates are declining or stable, but when they're rising, that can really come home to bite you if you needed to sell them in an emergency and you couldn't hold them to maturity. The other thing about bonds is they may or may not have tax benefits. So municipal bonds, some of those have tax benefits, but corporate bonds, for example, typically don't. So what's different about the general account? So the return that you're paid on the general account is not the prevailing yield. What it is the blended average or the blended coupon rate, of all the bonds in their portfolio. So rather than change the mark to market, what they do is they say, hey, I bought some bonds at different rates. The blended rate is the rate you get. Now this turns out to be super critical, because what they're doing in exchange for that lack of fluctuation is they're protecting the principal position of the bonds. This is why the surrender value of your life insurance doesn't change daily if you're in fixed products, not variable products. So universal life, whole life, IUL, the surrender value doesn't change just because the Fed raised interest rates by 1% or 2%. Why is that? Because the carrier is principally protecting the value of that bond. And they're doing that because they hold them to maturity. So the accounting is different. So on one side, you don't suddenly get a rate increase just because the Fed increased its interest rates, but you don't have the risk of losing value. Now, when it comes to the leverage, the fact that it can't lose value outside of insurance policy costs, there's no investment value loss, is hugely significant if you're a lender putting money into a program where basically you've got a principally protected asset. So it's now super, super safe. So unlike property, cars, almost anything else that you can use leverage for, unlike that, the life insurance cash value of fixed life insurance is super safe for lenders. Okay, we can take advantage of that. So just to give you some visual representation of this, to explain the general account composition a little bit more, if in year one I buy some bonds and interest rates are gradually rising, right? Year one I buy some bonds, let's say at 4% return. And in year two I buy some more bonds at 5%, and year three, 6%. The prevailing market rate if you had a bond portfolio would be 6%, but my overall bond value, my mark-to-market value would have gone down. In a life insurance contract, your value would not have gone down, but the average, assuming they were all the same size, et cetera, my average rate would be the average of 4, 5, and 6, so 5% would be the return on that general account. So what you can immediately start to see is if interest rates go up or down, the portfolio of the general account is likely to lag it by the amount of bonds they're replacing each year. So some tremendous advantages, but some differences that we can take into account. All right, so as I go through this rising rate environment, I should anticipate just some portfolio lag, and this graph shows the actual data behind this. So this is taken through the 80s, late 70s and 80s. We have Northwestern Mutual who's published data on this. And what you can see on this chart is that the bond yields go up quite rapidly and the portfolio rate lags it by 3 to 5 years, depending on how you're looking at it. Tremendously valuable in a declining interest rate environment, but we happen to be in the opposite. So how's this going to impact us? So the last thing I want to talk about is the difference between an index universal life and an index fund, because a lot of CPAs and advisors get this muddled up. And so if you think about what the index universal life does, takes all your money, shoves it in a bond portfolio, but does not give you the bond return. Instead, it uses that return to purchase an option. A long option is the phrase they use. And all that is a bet on the market going up. But with an option, what you're measuring is change per year. You're not invested in the market. So you have the principal protection of the bonds. All you're really arguing about is what kind of return you get. So whereas, let's say I invest in the S&P. S&P can go up and down like a yo-yo, as we're seeing. Well, more down than up this year, right? So I think the S&P is down like 20, 21%, 22% this year. What would happen in an IUL is you've limited the range of returns to either a zero every time the market's negative. So let's assume the S&P is negative 20% this year. You have your bonds giving you your principal protection, so you have zero. But what you don't get is any growth. Now, you still have insurance policy costs and all those things coming out. So you might see some decrease, but you're not getting an investment loss. And it's kind of neutral about whether the market's 1% down or 50% down. You just get a zero. It doesn't make any difference to the product. When the market goes up, that option credits a positive return, and that gets reinvested into the bonds. So what you're really looking at from an investment return, if we compare the difference on this chart, the S&P can go up and down. So for example, 2000 to 2009, the S&P went up and down like a yo-yo, and after 10 years, you had no net positive in the market. An IUL, by contrast, would have recorded zeros every time the market was negative, gone up when it was positive, locked in that up, and then followed by a zero if the market corrected again. So your return looks more like going up a staircase than it does going up and down like a yo-yo. So very, very different risk profiles. And that's important again, because the life insurance illustration doesn't differentiate risk between something that's highly safe, something that's intermediate, and something that's more risky. And yet you're looking at numbers as if they're the same thing. And yet outside of life insurance, we would look at treasuries and stock portfolios completely differently because we understand intuitively there's different risk. It's just not reflected in the same way or explicitly stated in life insurance. So understand that. All right. So what happens to your policy when you make a payment into it? Now, unlike conventional purchase of life insurance where you tend to just pay the minimum premium, we're doing the opposite. So we're paying the maximum premium. So what's happening there? You put your money into the policy They take off the policy charges, the cost of insurance, all those good things that are basically just costs. But the extra money is invested into that general account we've just described. And a small portion, the portion that's related to the interest rate return, is used to purchase the option. And the phrase the industry uses for that is option budget. So if you think about it, my option budget is going to change, and it will change every single year as my portfolio return changes. Now, technically, the way it works is the carrier guarantee the rate for you for that year. So you've got no moving parts within the year. But every single year there's a new reset. So if interest rates start to go up, what will happen over time is my portfolio rates will go up as I'm taking old bonds, replacing them with new bonds. And so my option budget goes up. And what we know from tracking this data is that your cap is very, very highly correlated to the amount of money that you have available. So all things being equal, this is a simplification, I know. As my option budget goes up, my cap goes up, or my ability to capture more and more of the upside. Likewise, if interest rates go down, the opposite happens. A lot of people sort of look at the caps, particularly people unfamiliar with the space, and go, the cap is the cap and it will never change. It will change every year. And that's a useful thing, particularly if interest rates are going up. So how do they calculate it, right? So it basically comes down to just maths. If I have $100 of cash value or premium, I'm going to invest enough of that money into my bonds so that I can come back to par with my growth rate. So let's say my growth rate is 5% in this slide. I know that mathematically, if I put 95.25% of the money into bonds, the 5% return will bring me back to zero. That is where your zero floor is coming from. It's just maths. It's not a company underwriting the market. It's not any of those things that are actually unsustainable. This is hugely sustainable because the carrier's not placing their balance sheet at risk. They're just systemically building into the product this guaranteed floor. Again, the floor, I'm ignoring contract costs, which come out separately. So my option budget's just leftover money. So in this case, my 5%, I put 95.25% into my bonds, not into my but into bonds. Times 5%, I get back to my par $100. This leaves me 4.75% available to buy an option of some kind. So my option budget will change. This is why my caps change. Okay, so what happens then? Well, the carrier takes that money and says, okay, what's my option cost? Now, option cost, you've all been hearing, if you've been following any financial news, that volatility, that's another fancy market word for just riskiness of the market, has been going all over the place. So the option cost is driven by volatility, how much risk there is associated with the people selling that option having to pay out. So the more volatile the option and the higher the volatility of the market, like the S&P right now, highly volatile, that makes the option expensive. So you could have a situation where my option budget goes up, but my price goes up, and so I'm net neutral. But more and more these carriers have been buying low volatility options. In other words, they don't change that much in price. So as my option budget goes up, I have more money to spend. I get more of the upside of the market, however they calculate that, either by a cap or an increased participation rate. Participation rate is just another industry word to describe how much of the market you actually participate in. All right. And as mentioned, caps will change every single year on policy anniversary, up or down, depending on the prevailing rate and option prices. So if we boil that together, what is the difference between an IUL and a bond, or an IUL and a universal life that's basically investing in bonds? Both products have their principal protection, but the universal life is just going to give you the fixed return of the portfolio. And IUL is placing at that at risk. So do we get a risk premium for taking that risk? And the data is in on that one. Every carrier has published this data. The economic analysis has been done on this. And the risk return that you're going to expect to see over time, obviously not every year, is about 2% more than bonds. So how does this all come into play when we're looking at using leverage? Leverage is typically done at a loan rate that's based off LIBOR. Now, LIBOR is being replaced by all sorts of things, and they'll eventually come to some conclusion that's common for everybody. But let's use LIBOR for now. The banks will price a loan at LIBOR plus a spread that is generally below the general account rate because it's super safe for banks. Okay, great. Now, with an index, if you take the S&P, just statistically, 7 out of 10 years are going to be positive. 3 out of 10 years are going to be negative, so you'll have 3 zeros. So you're not going to get a positive risk return every single year. By definition, it's risk, right? But what I will get over time, unless the way the market prices risk entirely changes, which, by the way, hasn't changed mathematically speaking at all since 1928. So I think it's a reasonable assumption that the market knows how to price risk. So if we look at that, the index universal life over time will give you about a 2% risk premium. Of course, that's not guaranteed because it's risk, but statistically speaking, the longer you hold it, the higher the probability of that risk premium holding true. This is one of the reasons we say to people, look, whether you're doing Kaizen, whether you're using just a regular IUL, don't start taking money out of it too soon because you don't know where that risk premium has had time to normalize out. So just to summarize this section, option budgets and interest rates are highly, highly correlated, but in a lagged fashion because of that portfolio lag we talked about. The increased option budget as interest rates goes up gives you the potential to capture more and more of the upside. But in order for that to work, obviously the index has to have a positive year. I might get to an uncapped S&P, but if the S&P is negative, I still get 0. Over time, we know that correlation is in the high, 85, 90%. So essentially that's the key driver here. So we know that we'll go up and down with interest rates over time, and that's crucial to understand because it's not reflected in the illustration at all. Okay, so at the end of part 1, we talked about the interrelationship between the general account of the carrier, the option budget which drives the capital participation rate of the IUL, and how correlated they are to interest rates. Well, that all sounds good and dandy over time, but the real question is, what problem does that create for me? And it's not really about interest rates going up, it's about the rate of change. Because we now know from the part 1 that the general account is going to lag underlying interest rates. So that creates a problem for us, right? What happens if interest rates go up suddenly and the portfolio rate of the carrier doesn't respond quickly enough? Now, carriers want to respond, but the maths is working against them in this situation. So, just as a reminder, the purpose behind this is how do we attract more money into the plan so we can hit our supplemental retirement goals or quality of life goals or have money available? We need more money. We need to attract leverage. How do we do leverage in a safe way is the key concern here. So let's look at where we are with interest rates. The Fed has announced multiple interest rate rises this year, is planning, or the market's planning in multiple more rises over the next 6 months or so. And we know that there is a lot of speculation out there about where inflation is going. And everybody has an opinion, but nobody has the crystal ball that's perfect. So rates are going up. What you'll see from this chart is that historical interest rates hover around 4.6%. So that means in loan pricing, by the time you add the bank money on there, it's closer to 6%. We're not even close to that right now. So we've been lulled asleep, if that's the right word, by a low interest rate environment created for a whole variety of reasons. But our interest rate environment right now is not anywhere close to historical averages. Now, I make this point because when we were designing Kaizen, to assume interest rates stay low forever was just naive. So we assumed interest rates would go up, but we didn't know by how much, so we build quite a lot of buffer in, as we'll cover. But what we're really worried about, if you think about it, is how much will that lag bite us? So let's look at what happens here. We have an illustrated rate from some insurance illustration. We have a projected loan rate that's using, in our case, what we use is the interest rate forecast the banks themselves are using. with the loan price added on. So we have a pretty good feel for that because the banks have a good handle on interest rates, or at least they feel they do. But the worry is this. Something happens. Whatever the trigger is, maybe it's something like in the early 80s where there was the oil crisis or whatever, interest rates suddenly go out of control. And so what people worry about is basically my loan cost getting above my policy return rate. Now, part one was to show you that over a protracted period of time, that is, unless the way the entire economy works just completely changes, in case we've got bigger problems, that's not going to happen over time. Now, I make the point and stress the point because we get a lot of people who haven't thought about this saying, well, what happens if my loan rate goes to 8 and my policy return stays at 6 in perpetuity? Well, they've just described the collapse of the entire economy, but they don't realize they've said it that way. But what we can have and should fear is what if there's a sudden snap in interest rates? So how do we address that? So what's going to happen with the IUL, we already know, is that over time in a lag fashion, the option budget will go up. And statistically speaking, that means that the caps will go up, which means my ability to capture the market upside goes up with it, but it will be delayed. And so if we look at that delay, what will happen is, let's say 2 years' time, that cap slowly starts to rise. As the market goes up and down, you still have the same number of zeros and same number of upsides, but I capture more of the up. Now, we like that because if you think about it, if the market crashes 40% because of the inflation woes and fears of the economy and everything goes wrong, market crashes. Sometime later, next year, the year after, market rebounds. Well, if we got a zero in the crash, we want as much of that rebound as possible. So if my option budget goes up, that's kind of cool, but it's delayed. So I'll call this period the risk premium squeeze, when my cost of loan has gone up by my ability, but my ability for the product to perform is lagging that. So let's look at this squeeze period, because that becomes crucially important that we build enough buffer to cover that base. Now, the two changes that we already know and tell people about is the Zens, Kaizen and Trizen, have both built into them a buffer that accounts for a substantial squeeze, either created by a sudden rise in interest rates or a situation where, yes, I have a higher option budget, but I just don't get some good returns, so that more of like a depressionary environment. We've built both of those tests into the design already. So what we're really looking at is a short, sudden rise in interest rates. Now, if you go back and study the 80s, for those who are interested in interest rate history, which is probably none of you, all right, but you might get really interested now, right? Well, at least for 5 seconds. What we're looking at is how did that rate change happen? So if we go back to the 80s, what you'll notice is interest rates gradually rose through the 70s. You know, we were up at the 6% loan rate environment and everybody thought that was normal. And then there was a loss of control around the 80s when it suddenly, early 80s, when it suddenly spiked up to 18%. The point I'm making here is that rise in interest rate took 10 years or more to happen. And then it took 30 years to de-escalate, right? So we know it doesn't happen overnight. We also know at that time, if you had a bond portfolio, they were throwing out 15, 16% rates of return. And for those of you who remember back in the old days of universal life vanishing premium, the problem was we would get 12% return on our bonds forever. Well, that was naive, right? And we're not going to make that mistake again. But what we do know is that in that environment, all the fixed income guys who run the general accounts of the life insurance company would be licking their lips because they'd be buying new bonds at 15, 16% yield, certainly over 10%, and that would drag the portfolio rate up. So what do we actually do in our stress test? Well, the first thing we do is we don't take 10 years for that to happen. Interest rates go from where they are today to 18.1% tomorrow. Now, I'm going to argue that would be kind of cataclysmic on the economy, but that's what we built into the design. The other thing that we built into the design is the portfolio rate. Those bonds inside the general account do not change their rate of return for 4 years. So a substantial delay. It means that those fixed income guys who are changing 12 to 15% of their portfolio every year fell asleep for 4 years and did nothing, even though in reality 48% of their bonds would need to be replaced. Now, if I changed 48% of my bonds in that environment, my portfolio rate would be above 10%. So after 5 years, we allow them a 1% increase to around 5.5% portfolio rate. In other words, they would all been fired, hung, drawn, and quartered, and thrown out to dry because they'd just done a god-awful job. And these are highly, highly professional guys, so that's not going to happen. But in the test, we actually suppress the ability of the bond portfolio to go up above 5.5% forever. It never, ever gets up there, even though our rates stay up from a loan point of view. Now, we're doing this for a reason. We want to see if we break the loan. We know that over time this recovers, but we're just putting a squeeze on that premium that has never happened to really make sure we build enough buffer into the design. Too often in the financial services industry, people cut corners to look good. This is designed to be a safety net. So we don't want to just not cut corners. We want to give them a nice swing, wide swing, so we got plenty of safety in it. So what this means is we built a safety net into this plan that is more than accommodating the worst interest rate period we've ever seen in US history. So that's a good thing, right? So just to put some numbers on that, here's our stress test data that we publicize. That has been validated by multiple people to make sure we're doing it correctly. Actually, they tell us because we're over stressing the design, that this is conservative even for an 80s design. Now that's built into the design that you're considering or looking at in Kaizen or Trizen, right? So that's there. But it's there for a reason, which is safety net. We're not trying to have the fastest car in this regard. What we're trying to have is a battle tank that can take any hits and dings and whatever, right? So it's designed to be a safety net. So in other words, we don't just build it in, we have it there as a safety net, but we show it. And so here's just an example of one of our proposals, where I just took one at random. We show you the expected outcome and how that is reflective versus your alternatives, but we're also showing the 2 test results on every single design, so you know what they look like, even with the conservatism that I've mentioned in there. Now, we do this because we're in a highly regulated industry, and we are not allowed to show the illustrated rate growing over time above where it is today. So we're showing a test that shows no response in effect in line with the test that we're actually running, and I mentioned. So what does this all really mean? Right now, because of the regulatory environment, we're already showing the normal situation where the expected risk premium is being suppressed by over half. So we're already in a position where we're showing half of what's ever happened over the last 30-year history. Take that back to 1930, actually. 15-year rolling averages, this kind of risk squeeze we're showing is going on for the rest of your life. Never happened. But it's there for a reason, right? That's what the regulators want us to do. In addition to that, we're showing the stress tests on top of that. So you've got something that's got a lot of conservatism built into it. But that's another side of that coin, is if I'm projecting lowball, then my probability of overperforming goes up. And we want that to be the case, right? We want it to be better than we thought it was going to be. So that's why we built so much conservatism into this design. So if I can find my mouse, where does this take us? In a normal condition, where we're showing even more squeeze than is normal, as our what we call a normal case, Kaizen has a very strong value proposition for most people. Not everybody, but for most people. We test it, and we've now got some robustness built into design. So the next thing people say, well, that all sounds great, but it depends, or it's reliant on the life carriers actually raising their rates. So will they? We mentioned that the difference between the general account and a bond portfolio is the carrier is protecting you against mark-to-market changes. So they protect the client, but that does not mean they're protected. So their nightmare is a mass surrender of bonds when they eat the loss. Now, one policyholder surrendering, that doesn't make any difference to them. They got $50 million floats, for goodness sake. But if suddenly 100, 1,000 people surrender their policies because carrier A is raising their rates and carrier B is not, that would decimate their profit and loss position. Now, when you're an actuary, you don't know where interest rates are going to go, so you price your product to be neutral. You take your cost of insurance out, you take your policy charges out. The option budget is not really where you're worried about making profit. So to not raise rates would be suicidal for them and affect their profit or re-inject risk to them. So if you're a complete cynic, and I've occasionally been accused of that, what you really want to do is make sure your interests are aligned with the carriers, which is the carrier will protect their long-term viability. And in this case, they're really, really aligned because the carrier must and needs to raise rate if, and here's the caveat, if they have a high dependency on this product type, the IUL, for their sales. So where we tend to focus is carriers that really, really depend on the IUL for their sales. Okay, and by the way, they are acutely aware of this risk. So no chief investment officer is going to say, hey, I've got a profitable product that I willingly inject extra risk in the short term in just to create that risk. That would be insane. So the key point to take away here is understand why the carriers raise rates, drop rates every year on policy anniversary, and why they are aligned in a rising interest rate environment with their policyholders. So what do we conclude from this? Kaizen was designed for the long term, not a short-term fling. It was designed to take into account stress conditions that are worse than we've seen historically and some of the worst black swans. But I'd also ask you to keep in context, if I'm using this as a supplement to generate income that I can use as a supplement for retirement, a buy-sell arrangement or whatever, I'm comparing it to what else I'd be investing in. What would happen to a stock portfolio in the Great Depression? What would happen to my bond portfolio's mark-to-market value in a rising interest rate environment? What happens to my real estate portfolio? We're not doing this in isolation. What we're trying to be is a part of your portfolio that is safe in difficult conditions and performs well in normal conditions, right? That's what it's designed to be. So this is just some of the background data that helps you understand what the thinking was and the economics behind it. So we also know, one last little bit, that carriers are actually already raising rates way ahead of where we forecasted them. So to conclude, unless the world changes the fundamental way it does economics and prices risk, these are a very prudent design. And they're done that way to try and preserve and protect your quality of life. That's the whole purpose. And in order to attract 3 times money per client for all the clients we have from the bank, so in other words, the bank could put hundreds and hundreds of millions of dollars into this, way more than me or you individually put in here. They have looked at this to make sure they're safe and that their loan is protected. That is why you don't get underwritten for the loan in Kaizen, because it's such a safe design for the banks. So let's remember that, but let's also remember this is also life insurance. So it does give you the life protections that, say, a retirement plan wouldn't do, or a supplement for retirement that wouldn't do if something you died suddenly, or you got sick and the living benefits would kick in. And also it's a great tax hedge. So we actually think this is a great environment when people are worried about recessions, when people are worried about rising interest rate. This is exactly the environment that we think Kaizen's designed for. So I hope this was useful for you. We hope that you do share, like, and spread this around so that more and more people can understand the logic and the economics behind. If you disagree with what we're saying, we'd love to hear from you and understand why, to make sure that there's nothing we've missed. But it's been kicked pretty hard. Thank you so much. I hope this was useful.